Hello, I'm Eric Mancini, Director of Investment Research and Wealth Advisor with Traphagen CPAs and Wealth Advisors. Thanks for tuning in today. And today we're going to be talking about the markets this year, and then plus some portfolio changes that we've already made and that we'll be making in the near future in response to what's going on in the world. So more specifically, the topics that we'll be looking at is the current market pullback compared to prior corrections or bear markets since 1980 to give us some perspective, and then also looking at the different sectors in the market, how each one is really performing quite differently depending on how it reacts to rising rates, inflation, and valuation. We're going to look at reasons why we have had this pullback, mainly elevated inflation, rapidly rising interest rates, aggressive Fed policy, elevated chance of some sort of an economic slowdown, and then China COVID lockdowns, supply chain issues. And also, again, we're going to be looking at, given all this, what we've done over the past couple of years, couple months, some changes in trades and investments that we're in progress now making, and then likely in the near future. And then lastly, we'll look at our outlook for the rest of 22. So first, this is a chart going back to 1980 of every single calendar year. The gray line represents the total return in that year, so what the stock market returned in that year. And then you can see, obviously, most years in the stock market are positive, which would be all the gray lines above. Occasionally, you have negative years, which would be these gray lines below the zero line here. However, in every single year, you have a drawdown of some sort, and that's what these red dots and red numbers represent, is how much from top to bottom the stock market went down in any given year. So, on average, over the past 40 years or so, the stock market dropped about 10% each year. That's the average drawdown in any given year. So a 10% pullback is completely normal, happens almost every year. We've had 8 20% pullbacks since 1980. So that happens once every 5 or 6 years. So far this year, we're right at the cusp of that. So late last week, we got to down 19.9% on the S&P 500, so essentially a 20% pullback. We've only had 8 of those, so those happen less so, but still happen every so often. So that sort of gives an idea of where we are. So drawbacks happen every single year, 10 to 20%. Happen more often. Once you get to 20% or more, which are right on the cusp, those happen much less often. And then we'll dig into by sector. So this is a graphic that represents all the different sectors in the S&P 500. And it's also proportionate by size. So this largest square here represents technology, and that is the biggest weighting within the S&P 500. And also, unfortunately this year, it's been the worst performer, along with consumer discretionary, which really is a technology sector as well, that has Amazon in it and other type companies. However, fortunately, Traphagen's been in a position where we are overweight healthcare, we're overweight utilities, and we're overweight energy in the form of pipelines. So you'll see our healthcare overweight, it's still down on the year, but less than half down the overall market. Again, healthcare continues to grow, it's recession resilient, and it's cheaper, and it is defensive. So that has a nice outperformance. Utility sector, we hold through the mutual fund ECOIX, which is global utilities that have a tilt towards clean energy. That's down about 8 to 9% this year, but again, overall market's down almost 20, so that's been a nice relative outperformer. And the one big winner was energy. So we're overweight energy in the form of mostly oil, natural gas pipelines, and we're up 20% this year. And if you take up 20% versus down 20% for the overall market, obviously that's been a huge help to the portfolios. And we are also overweight, especially recently, and we might actually add to this, as technology is coming in so much. We still think that over next 3, 5, 10 years, technology is a place you want to be, with just the continuing growth in that sector. More and more companies need more tech. It's just the way we're going. So we do want to continue to have exposure there. We just want to have it in the right type of companies, which would be the Apples, the Microsofts, the Googles, companies like that, as opposed to companies that are not making any profits. And then, getting into what's causing this, pullback this year. One is certainly, to nobody's surprise, inflation. So this is a graph going back to, again, about 1980 of inflation rates through time. This is certainly the highest inflation we have seen since about 1981 or so. At 8.3% was the latest reading that came out about a week ago. It's certainly an anomaly. We have not seen anything like this, since the early 80s. And really, 90s and the 2000s and the 2010s, we've been pretty comfortable between 2 and 4% for the most part. Even recently, even 0 to 2%. Deflation's almost been more of an issue. But here we had that hard spike, and this is oil, natural gas, cars, houses, food, you name it, everything is up materially. And that is what the Fed is trying to fight. And that has scared a lot of stock investors. Now, what we also look at is not just what inflation is now, but we look ahead to see what the market thinks inflation will be in the future. And that's called the 10-year projected inflation rate. That was as high as 3.05%, meaning the market thought going forward inflation was going to average 3.05% per year for the next 10 years. That has actually fallen somewhat to 2.7% over the past couple weeks, which is a good sign. And then hopefully we see that either stabilize or continue to decrease some. Another reason is rapidly rising interest rates. So this is a chart of the 10-year Treasury for the past 10 years since 2012. And it's just been a very rapid increase in the 10-year Treasury rate and 30-year rates, 2, 5, 7 years, really across the curve, except for the very short-term rates have exploded this year. And that causes all types of effects. It affects how you value stocks, mortgage rates, the 30-year fixed, about 5.5% or so. So, this rapid rise in interest rates certainly changes how a lot of people think about investing, their allocations. Maybe they sell some stocks, go into bonds because now there's a better yield. Maybe they have trouble buying a house because the mortgage rates are up so much, or financing a car, or what have you. So this is certainly something we're looking at. It's the 10-year hit 3.2% a couple weeks ago. It's dropped back down to about 2.9% or so. And again, just like that inflation number, if we see this stabilize or drift down, that would be positive for the stock. And then, lastly here, what's causing this is because of inflation, the Fed is aggressive in terms of tightening or trying to slow demand or actually slow the economy. So the top chart here is looking at the Fed funds rate, and this is going back 20 years. And this is the rate, very short-term rate you get on cash or savings accounts. This goes back to 20 years, so 2002. This is the Fed hiking aggressively right before the Great Recession back in 2007, 2008. They actually had the rate up above 5%. Then they reduced it to 0, was at 0 for a long, long time. Then the Fed started to raise that prior to the pandemic recession, got up to about 2 and change. Ever since the pandemic, it was at 0. And just recently, a very steep ascent in that rate, and we would expect this to continue. So right now it's looking we could certainly be in this range here, where their current projections, the market and the Fed are looking at somewhere a rise in the short-term rates of 2.5% to maybe a little over 3%, and that probably is within this year. So that's a rapid increase in rates. They're also looking at the balance sheet, which is a chart of the Fed's balance sheet assets. So the more assets they have in the balance sheet, the more assets they're buying. Mortgage securities, municipals, corporate bonds, treasuries, what have you. And that, if they're buying assets, they're bidding up prices, and that is generally good for risk assets. If they're letting it run off or selling, that's a tightening of financial conditions that's attempting to slow down demand or slow down the economy. And what we've seen over the past decade here is when the balance sheet expands, that is bullish for risk assets, stocks. When it runs off or balance sheet assets go down, that is bearish for risk assets. Since the COVID, they have exploded, essentially, the balance sheet to, about 2x in 2 years. So 2 times the assets they had back in 2019, 2020. We have 2 times that amount now. They are just beginning the process in June of reducing those balance sheet assets. So all else being equal, that is a negative or a headwind for risk assets, but that is what they are trying to attempt to do. Between rising rates, reducing the balance sheet assets, they want to slow down the economy. And of course, we're cognizant of that. What they're hoping for is they could slow down the economy without causing an actual recession or a very, very mild recession. And then lastly, there's no chart on it, but another thing leading to this thing is to this market, turmoil and drawdown is China in terms of their COVID lockdowns. That's causing supply issues all over the place, in addition to just disrupting overall global economic activity. So that is slowing down things over, certainly in Asia, and that's having ripple effects here as well. And lastly, in terms of what the Fed is attempting to do, they're trying to slow the economy. So we would expect an increasing chance of a slowdown or recession. This is our Traphagen Recession Index. And this is a chart since we incepted it back in 2016 through now. And as you can see, back in mid-2019, we had it predict accurately the recession around in early to mid-2020. Obviously, it didn't know a pandemic was coming, but it did see signals of a recession regardless if there was a pandemic or not. Most likely would have happened anyway. So it saw other signals regardless. And it predicted a higher or a much above normal chance of recession back in mid-2019. That got into the 50% to 60% range. We're not quite there yet, but we're certainly elevated. We're at about 45% chance of recession over the next 12 months now. So we are starting to take defensive actions and have already taken some as well. So these are all the portfolio moves or investments we've made. The ones on the top above this top line, these happened already. So really, and we've been speaking about this for years now, over the last 5 to 7 years, taking almost all of the bond exposure out of portfolios. So for the vast majority of portfolios over the last 2 years, call it, they've either had de minimis or no exposure to traditional bonds or fixed income. We've replaced that with our alternative and private investment suite. And just from January 1st, 2020 through today, that's saved approximately 7 to 8% in actual client total portfolio returns, or roughly 70 million in client assets versus traditional 60-40. So that by far is the biggest protection or value add that we've already done, and that's already in the books, and value add has been had there. The other thing is we eliminated the vast majority, if not all, of our emerging market exposure 1 to 2 years ago. And then earlier this year, we had about 3 to 5% left in foreign developed stocks. That was sold. So now we have 100% or near 100% just U.S. stock exposure. And that was placed in very high free cash flow producing U.S. stocks. So not speculative tech. These are just very solid, high quality, lower debt, high profitable U.S. companies. So those are defensive actions we've already taken to this point. As we speak, we're making these changes. So we're trimming some small cap U.S. stock exposure, which could get hurt further in any type of slowdown or maybe a recession. High yield bonds, we're trimming. Cash, now that bonds have finally are now producing better yields, we're taking some of the cash that we had on the side and putting that towards bonds. And after private real estate had a 25% or so up year last year. It's up another 11% or so this year. So we're taking some of that profit. We're selling off that. We just got out of that. So that generated 2% in cash after that huge, outperformance. And now we'll look to deploy that cash where we see opportunities. And then, depending on what portfolio you're in, we'll add possibly more diversified private credit, investment grade bonds. Diversified private credit, for instance, still not associated with the stock or the bond market. You get about 8% yield there. Investment grade bonds, you're getting about 4.5% there. And then on the bottom, we're going to also look to sell some portion of our private equity position. So this is the ticker on this fund is PIIVX. And that has done, again, very, very well last year and this year. With this year, for instance, it's up about 3.5%, while the stock market's down 20%. We want to take some of that outperformance, take the profit on that, and then we'll redeploy where we see longer term opportunities. That could be near term, could be midterm. We'll see where we deploy that as the markets dictate. And then also over the next 1 to 2 months, given the decreases we've seen really across the board in all types of stocks and some other securities, we're going to actively take advantage of that by tax loss harvesting. So we're going to sell some things that have losses on them. We're going to replace those positions with similar, not exactly the same, but similar types of securities, and then we'll harvest those losses to either reduce or eliminate 2022 capital gains taxes. And then lastly, we're going to look at remainder of 22, our outlook. So largest factor is the Fed and the interaction of Fed policy and inflation trends. So if inflation really does start to trend down or top or roll over, and the Fed becomes much more dovish or friendly to the markets, that would be a huge positive. So we're looking, keep an eye on that, and vice versa, of course. That being said, high volatility is probably likely in the foreseeable future. We really don't see any lessening of that unless we get and until we get clarity on rates, Fed policy, inflation, and the Ukraine situation. We're looking at, because this year has had very stark differences in performance between sectors and industries, we'll continue to reallocate as needed between different sectors and industries. Again, we've discussed it with a elevated or increasing chance of some sort of economic slowdown. We've taken defensive action already, and then we'll look to take further action if we feel that's warranted in the future. But, all this said, there's several positive catalysts as well. So we have, one, a much cheaper stock market than we had really over the past couple of years. So stock market last year was trading roughly at 21, 22 times earnings. As we speak now, it's 17 to 18 times, which is more closer in line to the long-term average. So that's good. Earnings, so far at least, have stayed strong. So even on top of last year, which was record earnings, they look to be either flat or even growing some still on the corporate earnings side. So those have hung in there. That's a positive. And again, if we have any type of Fed pivot to be more dovish, that could be a pretty, or inflation rolling over or something like that, or a combination, that could be a really strong ignition for a market rally going into the future. So that's what I had today. Hopefully that answers some questions. If you had any other additional questions, feel free to contact your Traphagen wealth advisor or myself. My email is there, eric@tfgllc.com. Thanks. Hope you have a great day. Bye-bye.